All right, welcome everyone. I'm Beverly Mills. I'm a trustee of the Sauerland Conservancy. I'd like to welcome you to this presentation tonight by Sneha Salgram and Robert Morris on the topic of planned giving. Just a little housekeeping before we get started. Our meeting technical host is Maya Robles from our Sauerland Conservancy staff, and she has the audio muted of all our participants while we all listen to the talk, so there won't be any distractions, but you are all free to turn off your own video. Our speakers will be presenting slides and materials for about an hour. After that, we'll have a brief question and answer period. If you'd like to ask a question, just wave or type your name into the chat bar and you'll be called on. You'll be able to unmute yourself at that point. Finally, this talk is being recorded so that we may offer it to others on our website. So please go ahead and recommend it to your friends. I also want to point out that our executive director of the Sauerland Conservancy is on this call tonight, Lori Cleveland, and I'm sure you'll hear from her at the end of the presentation as well. If there are no questions, I'd like to introduce our speakers. Sneha Salgram has spent the past 5 years at the highly respected Edward Jones Financial Services Company, which has some 15,000 locations around the United States and Canada. She focuses on estate planning and takes special interest in educating and empowering those investors with a charitable intent towards nonprofit organizations. Sneha lives nearby in Plainsboro and is a volunteer and/or board member at several area nonprofits. Partnering with Sneha tonight is Robert Morris, an attorney at the well-known local firm of Stark & Stark. His practice focuses on estate planning, and he lectures frequently on this topic. He's the founder of the Mercer County Bar Association Estate Planning and Probate Committee. So thank you so much, and let's get started.
All right, thank you so much, Bev, for that wonderful introduction, and thank you to Lori, Maya, and Fran as well for having Robert and I here today to talk to you about planned giving. So give me 1 second and I'll share my screen and we can get started. All right, so today we will be talking to you about planned giving and why you need an estate plan. So my name is Sneha Salgam. I'm a financial advisor with Edward Jones in Pennington. The types of clients that I work with, aside from helping people with their estate plan and thinking about planned giving, are women who are in transitions, to those who recently got married, divorced, or lost a spouse. I work with younger families and business owners or busy professionals as well. My contact information is below, so if you ever have any questions after this presentation, you're more than welcome to reach out, or if you have questions about your specific situation after we go through this content. So what we'll be talking about today from the financial perspective is why you need an estate plan, some facts about charitable giving, as well as 4 planned giving options. So one of the most important things that I want you all to understand about the content we go through today is when it comes to your estate, even if you've taken no action at all, you have an estate plan. But does that plan that you have reflect your wishes? So why do you need an estate plan? So these are 3 kind of common phrases that I hear from my clients. So I want to go through these. So the first one is, we don't have an estate, so we don't need an estate plan. That's one of the more common ones that I hear. So maybe the word estate doesn't necessarily resonate with you. You might be saying to yourself, I don't have enough money or stuff to have an estate. Estates are what wealthy people have. But the truth is, you have assets and you have property, and you can choose how both of those will be taken care of when you can no longer make decisions, whether that be due to incapacity or if you pass away. What an estate plan is a set of tools that put you in control of your financial and personal matters, and it allows you to determine how you or your assets will be treated. Another common phrase that I hear is, it won't happen to us. And this is the thought that's never said out loud, but it is a subconscious belief that drives our decision to get around to it someday. But unexpected things do happen every day. And I think last year in 2020 was very indicative of that. That's a prime example of unexpected events happening and continuing to happen. So you never know what will happen. So it is really better to be prepared for all of this. And the third thing that I hear very often as well is we have a plan, so we're set for life. So if you were one of those people that followed some good advice early on and set up your will either in your younger years or when your children were born, that is wonderful. But do you remember who you named as an executor? Do you remember when your children will receive those assets? Is it age 25? Is it whenever? And is that plan still what you want today? And in relation to our topic today, is a lot of people like to give to their nonprofits, and maybe you do that on a monthly or annual basis, but have you included that in your estate plan? So if any of these questions are applicable to you, I really do hope that you benefit from our conversation today. So a few facts about charitable giving are that an estimated $41 trillion will change hands as Americans pass on their accumulated assets to the next generation by 2055. In addition to that, between $6.6 trillion to $27.4 trillion in charitable bequests is estimated to be made between 1998 and 2053. And lastly, total giving reached an estimated $295 billion in 2006, which was a long time ago, so you can only imagine what it is now. So we can tell that it's part of our society's culture, and it's ingrained in our culture to give. So we want to make sure we're prepared to pass on our wealth while we're living or when we pass the way we would like to. So here are 4 planned giving options from a financial perspective I'll be talking to you all about today. So I'll give you a brief overview of these 4 options that you have. And if you have any specific questions related to your particular financial question, I'd be happy to talk offline about that. But if you have general questions, you can feel free to talk about them during the Q&A portion. So those 4 giving options are qualified charitable distributions, highly appreciated stock, charitable remainder trusts, and life insurance. There are other options, but I'll just be focusing on these 4 today. So qualified charitable distributions. So this is an option people have, which is to donate up to $100,000 per year directly from a traditional or Roth IRA or inherited IRA to a qualifying charity. What a qualifying charity is a 501c3. So any charities that you intend to give to, you want to make sure they're qualified. Sauerland Conservancy is considered a 501c3 qualified charity. So this option is eligible to those who are 70 and a half years or older, and it can satisfy a required minimum distribution or RMD without having to include those distributions in your income. But the most important part about this is that it has to move directly from an IRA to a qualified charity. So I have 2 examples. So the first one is at the beginning of last year in 2020, right before the pandemic, the government passed what's called the Secure Act, and that raised the required minimum distribution age to age 72. So if you had to take a distribution from your traditional IRA, that age was now 72. So if you are 72 now and you're required to take a required minimum distribution from your traditional IRA, but you don't need that income at the moment, you can instead use that required minimum distribution and send that directly to the charity of your choice. So if you don't feel like you need that income, you do have this option available to you. Another example is I have a client who just turned 70 and a half, and she is still working part-time. And she enjoys giving to her church on a monthly and annual basis, but she prefers not to use the money she earns from her part-time job to give to the church. She would rather use the money from her IRAs. So now that she's 70 and a half, she's able to do that. She'll continue to give to her church, but instead, what I will help her take care of is move the money from her IRA and send it directly to the charity, the church, or other charity of her choice. Important thing to remember about this is to always consult your tax preparer first to make sure this is in your best interest. The next option available to you is highly appreciated stock. So if you have, this is when you have a concentrated position of a highly appreciated stock. you can donate that stock directly to a charity instead of selling the stock and then paying taxes on it and then donating cash. This way, you avoid paying capital gains taxes, and you actually might qualify for some charitable tax deductions. But the important part to remember about this as well is the stock must be held for at least 1 year, and there might be some limits on charitable contributions. So an example of this would be if you were one of those lucky souls that bought Apple stock in the 90s and you've seen it significantly appreciate since then, and you want to give a portion of your wealth to a particular charity, you can directly give that Apple stock to the charity of your choice if they accept that form of payment. And then what the charity can do is the charity can then accept it, and they are considered tax exempt organizations. So they'll be able to sell it and then use that cash. This way, if you're donating the stock directly, you're not selling it off and paying capital gains taxes. Instead, you're transferring it directly to a charity. So that's a good option to take advantage of. And again, consult your tax preparer first before making any of these decisions. Another option available to you, which Robert will go more in depth about after this, is a charitable remainder trust. So this is an irrevocable trust that allows donors to make a gift while providing an income stream for their lifetime. So what the trust does is it names a qualified charity as a beneficiary after you pass away. So you get the benefits of the income while you're living, and then when you pass, whatever is remaining in the trust will go to the charity of your choice. You might be entitled to some income tax benefits or reduced federal estate tax benefits at the time of your death. And this trust can be structured in different ways, like an annuity trust or unit trust. And if you have further questions about that, I'd be happy to talk about that afterwards. But the people it is useful for is those who have highly appreciated assets like highly appreciated stock or property, and they want to take advantage of this and diversify and potentially defer capital gains. So again, consult a tax preparer as well as a state attorney about this option. And the last option that I'll be covering today is life insurance. So a lot of people see life insurance as a protection tool, especially if you have a younger family or you first started working. But life insurance can actually be used as a wealth transfer tool as well. It can enhance the value of the assets that you pass on to create a legacy. So for example, if you have a certain dollar amount in mind that you would like to give to a charity or multiple charities of your choice, but maybe you don't have that in assets, you can take a life insurance policy out on yourself and list the charity as the beneficiary. That death benefit, when you pass, is then paid to those beneficiaries free of federal estate and income taxes. So the good part about life insurance that it is more flexible, because what you'll be able to do is you could potentially leave the money to multiple beneficiaries. So if you want to leave a portion of your wealth to your family or your children, but also to a charity, then you can list multiple beneficiaries on a life insurance policy. So it does have other purposes other than protection and charitable giving. So what we covered today are qualified charitable contributions, highly appreciated stock, charitable remainder trusts, and life insurance. So these are 4 tools you can use to pass on your wealth while you're living or when you pass to a charity of your choice. So again, this is my information. If you have any just general questions about these 4 giving options, or if you have specific questions about your situation, I'd be happy to talk to you about it. But for now, I will pass it on to Robert to talk about the legal side of planned giving.
Okay, can everybody hear me? And can you see the slide up there? Nobody?
Yes.
All right, good. I'm glad you can. So I'll try and build a little bit on what Sneha said, and we'll just use one example here. So many folks in the area where we live, their 3 main assets are their house, They may have an investment account, and then they'll have either an IRA, a 401k, 403b, or a combination of all the above. So building on what Sneha said, if anybody wants to chime in, what do you think? You want to leave a portion of your estate to a charity. What do you think you might want to look at first of those assets that I gave you? And that's just a typical person. Again, your asset structure may differ. Anybody want to guess? Everybody going to be quiet. That's okay. There's no right or wrong answer to any of this. So I'll just answer my own question then. So typically for most folks, the asset you might want to look at first would be your pre-tax IRA or a pre-tax 401k, or also known as a traditional. The reason is all the distributions that come out of that account are subject to income taxes. So if you just want to look at it from a pure tax perspective, you can name a charity, so it would be a qualified charity. What you're looking for in that regard would be a charity that's designated as a 501c3. And you can name them on as a beneficiary of your traditional either IRA or 401k. Again, you don't have to do the whole thing. The percentages run from 1% all the way up to 100%. And whatever you feel the most comfortable with, you can put any of them down. So it's an easy way to leave money to charity. It's also a fairly tax efficient way to leave assets to charity. And it's one that we often talk about with many of our estate planning clients. I am going to talk about charitable remainder trust, but I do want to kind of set the table a little bit and just go over, where taxes stand right now, because everybody's always interested in taxes, and where we might wind up before the end of the year. So I think we're all well aware there's been a change in the political landscape down in Washington, which before the year's over may result in some legislation that affects the estate planning area, both in terms of income taxes as well as estate and gift taxes. So the first item I have up here on the screen are some possible tax increases on income over $400,000. Again, there's a possible expansion of the applicable Social Security tax, as well as the restoration of the top marginal income tax bracket, which is 39.6%. I do want to talk a little bit about taxation of capital gains, because that's really important. And before I do that, I understand everybody probably has a little bit different understanding level of what capital gains are. So if you're, pretty conversant with the topic, then, maybe you can relax for a minute. If you're not really sure what I'm talking about, then hopefully the next few slides will share with you what the issue is. So for many folks, they own stock, for example, for a long period of time. Capital gains can also affect real estate or other investments, but the easiest one to think about would be stock. And the example I used here is AT&T stock, right? So everybody has it either in their own portfolio or maybe like a aunt or an uncle or a grandparent that's purchased AT&T stock years ago, and now it's worth more than what they paid for it. So again, hypothetically speaking, suppose they purchased it at $10 a share, right? And then they went to sell the 100 shares of AT&T stock, which you see up at the bottom of the screen, at $35 a share, which is roughly where it's trading at right now. So the capital gain in this hypothetical would be $25 a share. And that's the difference between what the individual paid for it and what they realized when they sold it. So they have a $25 capital gain. If they held the stock for more than a year, it'll be a long-term capital gain, and that's taxed usually at either 10% or 15% under current law of the total gain. A related concept that's really important is the basis step up. So what are we talking about here? So instead, suppose our person, again, whether it's aunt, uncle, grandparent, or whoever, had held on to the shares of AT&T and they never sold it. And in fact, they continue holding it on until they passed. All right, so what happens when they pass under current law is the stock gets a basis step up. All right, so the only exception to this, by the way, is if you own it in an IRA or a 401k. There's no basis step up on those. But if you just own AT&T in a general managed account that's not part of any type of retirement plan, you'll get a basis step up on it when you pass. And again, in our hypothetical, suppose the AT&T stock was worth $35. Now the fair market value is $35, and you could sell it and you would realize little, if any, gain. So it's an important concept to keep in mind. And what we're talking about again is the basis step up on the stock. All right. So there are some potential changes in capital gains taxation. The basis step up at death that we just talked about, they're considering repealing entirely. So there would be no longer a basis step up, and it would just be a carryover basis. So the beneficiary would just simply take the decedent's basis in the stock without it being stepped up. I skipped over Roman numeral 1 here. That's really important. There's been some generalized talk about taxing capital gains at ordinary income tax rates. Again, the only proposal that was made was the potential for the 39.6% rate to apply on capital gains and all income over $1 million. Who knows exactly what will happen, but that's on the table. Again, treating capital gains as ordinary income. If you're in the top bracket, don't forget the net investment income tax. So that's an additional 3.8% on top of the federal income tax rate. And then again, I think most people are residents of New Jersey, and you always need to keep New Jersey income taxes in mind. And I think we're all aware that New Jersey treats capital gains as ordinary income and taxes it the same as your wages. So there are some potential ways to address this. Again, if you're considering making a charitable donation, as Sneha just ran through a couple examples of outright donations of highly appreciated stock to a charity would be helpful. And then you get the deduction based on the value of what you contributed to the charity. So that's one way of addressing it. Another possible way is the use of a charitable remainder trust. So in this slide right here, this is generally how they work. Again, it's been very simplified here, and there are different types of charitable trusts. But in this example, you can see the individual takes property and they contribute it into the trust, all right? And that can be whatever property you think is appropriate. It could be cash, stocks, bonds, doesn't matter, all right? The trust then, by its own terms, pays back an annuity to the annuitant. And that can be a variety of individuals. It can be the person who contributed the assets to the trust in the first place, but oftentimes it's a spouse or a child, right? And in accordance with IRS rules, the annuity must be anywhere from 5 to 50% of the trust assets, all right? So you do get a charitable deduction for a contribution to the trust. It's somewhat of a complicated calculation. You have to do a present value determination of what the annuity is worth. There's no deduction for that. And what you're trying to achieve is a valuation of the remainder interest, which is paid to the charity. And you do get a charitable deduction for that remainder interest. So after the annuity period expires, and that can be set in a couple different ways. Sneha mentioned one is that the trust pays the annuity to the annuitant for their lifetime. Another one is that the trust can simply pay out over a term of years, 10 years, 20 years, what have you. All right, but whenever that period expires, whatever assets remain in the trust, this is why it's called a charitable remainder trust, they get paid over to the charity, all right? Moving on to estate and inheritance taxes. Again, these are all things that you need to consider. Now, New Jersey had an estate tax, but that was repealed in 2018. Who knows if they bring it back? I think we've talked earlier about there have been some budget struggles in New Jersey. So it's possible this tax may come back, and it's an important item to keep in mind. Now, although New Jersey repealed the estate tax, it still has an inheritance tax, and that's still on the books. Now, most people don't need to worry about the inheritance tax, and that's because spouses and children are exempt, grandchildren are exempt, and of course, donations to charity are exempt. But other beneficiaries are not exempt. So if you want to leave any portion of your estate to a brother, sister, spouse of a child, spouse of a deceased child, nieces, nephews, cousins, more remote relatives or friends, guess what? Now you've got to worry about the inheritance tax. So this is an important tax to keep in mind. Again, if you're charitably inclined, then all distributions and payments from your estate to charity are inheritance tax exempt. Finally, there's the federal estate tax. Now, currently, there's a unified exemption, and that's for the federal estate, gift, and generation skipping transfer taxes at $11.7 million per person. So for a married couple, that's over $22 million. All right, so it's a pretty substantial exemption, and what it results in is the overwhelming majority of people don't have to worry about the estate tax. There's been discussions about possibly reducing the estate tax to $3.5 million per person. All right, well, now all of a sudden people need to keep the estate and gift tax in mind. I'll give you an example. So most folks in New Jersey own a house, right? And they have a retirement plan, and they may have investments. And they may think, well, you know, even if it goes to 3.5 million, I don't really have to worry about it. Well, guess what? You know, particularly recently, real estate's appreciated a fair amount. And when you start adding on the value of your house to the value of a retirement plan and your other investments, well, now all of a sudden, oh, and by the way, your life insurance, now all of a sudden you're sneaking up over 3.5 million. And the tax when you get above the exemption is pretty significant. It's anywhere from 40 to 50% of the assets that are in excess of the exemption. So it's pretty important exemption to have on your radar screen, particularly if it's reduced to a lower level. If your estate is going to be affected by the estate tax, then you really seriously need to be considering things like a charitable remainder trust to address the amount that's over the exemption. Again, if you're charitably inclined and you're under the exemption, well, there may be other options to address this. One would be you can donate a portion of your retirement plans to charity. And again, what you would do is look for those portions of your estate that would be most heavily affected by taxes. And generally speaking, those are your pre-tax or traditional IRAs and 401ks. And you don't have to be leaving the whole thing to charity. And as we mentioned earlier, the beneficiary designations allow you to designate anywhere from 1 to 100%. And you can pick a number somewhere along that spectrum that you're comfortable with. So the charitable donations are important, and it's also important that they be looked at as part of your overall estate plan. That concludes my portion of it. I know I covered some fairly difficult topics. If anybody has any questions, please feel free to ask me. I'd be happy to answer any questions.